Now, in the Forex market, entry point is also called order types, how to place order, how to get into the market. They are so called order, okay? There are two types of way you can enter into the market. Two different types you can get into the market. Number one is through market execution. Market execution, that's number one. Okay, you have right here. Market execution can also be called instant execution. Instant, and I are going to know the reason why it's also called instant execution. Instant, just as the name implies, you want to jump into the market that same time as that same price where you met the market. Instantly, you want to join the market to start buying or selling, as the case may be, based on your analysis. Okay, why we have the second type, which is pending order. Pending order. Pending order. So for this pending order, or can you say pending execution? Pending, just as the name implies, you have to wait for price to get to certain points. Just as the same way you set a price, certain price for take profit that, okay, when market get there, it should cut you out. So also you can also set a pending order, instructing your broker that when price get to this so point, when price get to 1.200.200, get me to the trade. That's what we call pending order. Whereas market execution or instant execution, or two of them can be used interchangeably, or instant execution is when you want to join the market as at that time. That's time. Okay, you don't have to wait. You join the market as at the current price. All right. So now we have explained market execution. Now let me explain pending orders. There are four major types of pending orders, and which is we have the stop orders, we have stop order, and limit orders. You can see we have buy stop and sell stop. This is one segment. These two of them, they are opposites of each other. This for a buy and this for a sell. We have buy limit and sell limit. So breaking down the pending orders into two categories, we have stop orders, and we have limit orders. So now, what are stop orders? So stop orders is an order that is placed, instructing the broker that when price gets to that threshold, it should trigger you and keep moving in the direction, in your desired direction. Now, first, what could be your desired direction? Let's say you have done your analysis in the Forex market. You're expecting the market to buy, but not now, not in any time soon, but later. But by that time, you may be away from your phone or doing some other thing, or you get busy and you may not just be aware when it's happening, okay? So buy stop allows you, that is, in that case, you want to buy, right? Or you want to long. Let me use blue ink. We have to be color sensitive now because, okay, in buy market. So you have to, let's say you want to buy at this point, all this point, they have price, let's say at 1.2300, okay? Then market is currently at this point, it's trending upwards and it's coming down again. Your analysis have told you that soon next, this market will flash up, okay? And when it hits this certain point, it will keep going up. And you don't want to enter here because you entering from this point, the market may still keep on going down, which will make you to lose money. So you have to set a buy stop order. You telling the broker that when price gets here, it should hit you, it should add you to the market and start buying and keep going up. Okay, that's what we mean by buy stop. So as market is trending, moving, dancing here and there, moving in the form of waves. So you will not be triggered into the market, not until it crosses this your line, this order that you ask them to add into the market. It will not add you until it crosses this point. Let me show you something real quick. Here is our point, 1.2300. Now let's say market trended this way. What if it did like this? It was about to hit you and started coming down in loss. Okay, you will not be entering into the market until you are hit, until it comes up to hit you and add into the market. That's when you only be triggered into the market. So that is why it's called a buy stop order. So once it gets here, it will stop and pick your order and start going up. That's when you make profits. So in this case, since you are buying, your take profit will be at the top, TP is at the top, while SL, stop loss, is at the bottom. SL is an acronym used for stop loss, while TP is take profit. While here is an entry point. But before you are triggered, it's called a pending order, buy stop pending order. before you are triggered. Once you are triggered, it's called entry point. That will not be your entry point. You understand? So the opposite is for sell. Why for sell? Now let me change color and explain for a sell. For sell, as market is going up and it's now coming down, and you place your sell order beneath, okay, then your take profit will also be beneath. And when market gets here, then your stop loss will be here. So market will come and trigger you. Once it trigger you, you only make money if you keep coming down. That's why sell. Because you are predicting that market should drop, you should sell. So if you pick you here and keep selling to hit your, if you hit your take profit, you make money. Or if you trigger you here and you can come here and cut it at any time, that's when you make money. Or however, if it did not get to your order and it reverses back here, this loss, you're not going to make the loss because you're not triggered into the trade. You're not in the trade at the first place. So that's the difference between a sell stop and a buy stop. Hope you understand. Now you would ask, why didn't I just enter the trade for a sell so that I can make massive profits of this one? I will make this huge profits. Why entering at this point? Now you will see reason with as time goes on. By analysis, you find out that there are some points, there are some places that by analysis you shouldn't sell. You shouldn't get into the market, because if you get into the market, it's trouble for you, because if you cannot sell here and the market will just reverse and start going up, because it would have happened to you several times. You say, okay, not until you have a very solid point. You say, okay, whenever market gets here, it cannot reverse again. You are very sure that market will sell off at that point. So that's the reason why people use stop orders. That's the reason why they use stop order, because so that they will not have fake breakouts. There are sometimes that this market can be so tricky. There are sometimes that as market is moving down, you will think, okay, since it did the same pattern yesterday, so today, if you repeat the same pattern, you should do what it did yesterday. Most of the time it's correct, but there are sometimes that it will just fail. Okay, that's because market behavior and human beings, there are people in this market, emotions, fear, greed, and storm, and so many other reasons. So your order that you enter as at this, let's say, okay, you sold, you immediately enter for sell order at this point, then it will just hit you and start going up. The next time you would have wished that, the market got to this point, then you set a sell order, because you are so sure that whenever you get to this point, it cannot reverse again. It will either go down. It will either go down or start consolidating at that point, and will give you more time for you to jump out of the market. So that's the reason why people use pending orders, see sell orders, and buy stop and sell stop. Okay. So the next thing is the limit orders. Now, limit order is a little bit tricky, so you want to pay close attention. Unlike this one that is very straightforward. Unlike this buy stop and sell stop that is very straightforward. Buy stop is set above the current price. Let's say price is coming out. You set it above that. When price come to pick you at the current price and it keeps going up, that's when you make money. Why sell stop is opposite. It's set below the current price. When price comes to your entry point, pick you and keep going down, that's when you make money. That's what you mean by that. So why for buy limit? Buy limit is an order that is placed below current market price, and price then goes up. That's when you start making money. For example, let me break it down. Okay, let's say now for buy limit, market is coming downwards. Let me change color for sell. Market is trending down. Okay, and then you are expecting it to hit some certain point, like you are expecting to hit here. This is your buy limit. This is your buy limit. You are expecting it to hit here and start buying. Remember, the buy stop is you place it above the current market price. But this time you want it, this sell, you are expecting that, okay, price will get to some certain point. It will not go below that again, and you start buying. That's your buy limit. So now it hits that point and start buying to trigger you at this point, to trigger you for a buy. Do you understand? So that's why it is called order placed below current price, this current market price, and price then goes up. Market is coming down fine, but you place an order right beneath it that as market is coming down, it should not take you for sale, but rather you are very sure that it will not break this support. It will not break this floor. There's what we call support and resistance, or floor and ceiling. This is ceiling. If it's at the fan at the top, it's called, if it's fan at the top, it's called ceiling. If it's fan beneath it, it's called floor. So you are very sure that these bearish guys, these people that are coming with this momentum, they'll be unable to break this floor. If you are very sure, then if they're unable to break this floor, what will happen? It will give you a reversal here to go up. So then you set a buy limit, set an order beneath that. Okay, you are very sure that they'll be unable to break this floor. So hence, if they're unable to break it, what happens? Opposite thing will happen to buy. So you set a limit, quoting this price, and you set a buy limit that when market gets here, it should pick you up right here and buy. You don't want to sell because you're anticipating a buy. That's what buy limit. So opposite is a sell limit. So for example, for a sell limit now, price is trending upward. You don't want to take the buy because you know that buy will soon end. And then you placed an order here to sell. Okay. Then price come here, it triggers you. Then from there, you sell. Hence, this is what we call sell limit. Now when price gets here, it cannot pass this limit. It will sell from this limit. This is the limit you give to it. From here, it will buy from this limit. That's the limit you give to it. So that's what it is. So in this case, for this sell, your stop loss will be above. For sell always. Stop loss is always above because you're anticipating for price to drop. Why take profit is beneath. Okay. Why here, the reverse is the case. For buy, TP should be above because you are saying price should go up. It's only when if it goes up, that's when you make money. If you come down, you lost. So if you come here, that's stop loss for buy. I hope that's clear. You repeat this video over and over again. If you don't understand, you can read that book for more clarification. All right. I believe I've done it perfect. I make it so simple for you to understand. Once you repeat this video, you understand it more better. So now the next one is trailing stop. Now, there may be time in the Forex market where you are making money. Remember the example we give about that during when I was explaining stop loss. Okay, let's say this is your entry point. This is your EP. All right. This is your SL. And this is your take profit. Take profit is blue. TP. Okay. And now price moved. It triggered you right here. Then it moved in your favor. Now this is your take profit. Okay, right here, it will hit you as in profit. Okay, now you're already in profit. Immediately, price triggers you at this line, then you're already in the trade. If it comes here and hit your stop loss, you'll be out in loss. But if price did not get to this point and come here and hit your stop loss, nothing will happen to you because you are not in the trade in the first place. Very good. Hope that with that established, we are good. We've explained stop loss. We have explained orders being triggered. Now let me explain trailing stop. Now, as price crosses this threshold, this is your entry point, you're already in profit. Then it's moving upward. There are times that price can even dance back and even come back. So, and even go below your entry point. If it goes below your entry point, here, you'll be in loss. Let me change the ink. From here, once it crosses here, you are in loss. This one is in loss, you're in loss. So, and if it comes back up again, from here, you start seeing blue on your MT4, blue again. If it comes back down again, you will be in loss. Okay. So what trailing stop is trailing stop, just as the name implies, allows you to start following up your profits. Now that price has gotten to this extent. Okay. Now that price got here. Okay. When price was currently here, let's say you have not seen this part here. This part has not happened. This is where the current price is. Now price has gotten here. You do not want to risk anything again. You want to move your stop loss line. This is your line. This stop loss. Sorry, let me change it to red. This is your stop loss line. You want to move this stop loss line above your entry point. So what that simply means, you are locking in some profits. You are allowed to move this your stop loss above your entry point. So you are going to change this value. You will change this value here. You move this stop loss to this place. So your stop loss value, new value will now be here. So they will erase this one that was here before for you, as long as you're in profit. Okay, this will now be your new stop loss. This will be your new stop loss. Okay, this will now be your new stop loss level. So as markets keep going, you see at this point it's kept going. It kept going because you don't want market to reverse and now come and hit your stop loss after seeing all these huge profits. So you would want to keep on moving your profits, trailing it, and following this current price. That's what we call trailing stop. It is an order that is sent to the broker, instructing them that as price move up in form of, let's say, as market is moving up in 10 pip, your stop loss should be following the market. should be following up. If you should be following it up back to back. If you move to this point again, then you should follow here again. It should not be so tight, because if it's so tight, any small retracement will just hit you out, and then later it will not make this huge move to pain you. But it should be following up reasonably, so that it will not hit you so early, so that whenever I do small, so that it can accommodate small slight retracement and still keep on going. So, but this act of moving your stop loss, following the market, locking in your profit, what we call trailing order. You can call it trailing stop. So, however, there's a system. This thing, I just explained it how you do it manually, but there's a system on your laptop. It's only available on your laptop that allows you to do it manually. You only tell the system, your broker, to be trailing it. Let's say if the market move in form of 100 points, then your stop loss will move also and will follow it gently. If you move in 100 points again, to follow it, to be locking into that profit. So no matter when the market reverse and hit you out, it will only hit you out in small profits. Okay, it will never hit you out in loss again. So that's a smart way to trade. That time you are not risking your money. Rather, you are trading, you're in the market, you are making money. Either you make more money or you make little money. So that's the smart way to trade. In that case, we call it a risk-free trade, or you call it a break-even trade. Break-even. That is, you have nothing to lose in that kind of market. You must win.